This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 370 was produced on April 6, 2023. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Gehring and Rozencwajg co-founder Adam Rozencwajg returns as this week's feature interview guest. We'll talk about energy, gold, copper, and much more.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, April 5th, 2023. The S&P 500 was up 1.5%, closing at 4117. We'll take a look at that chart in the post-game. The U.S. dollar index down 0.7%, closing at 101.88, remaining in a downtrend that has started since the post-FOMC period. The May WTI crude oil contract up 10.5%, closing at 80.61. We'll look at that chart, and Eric will have the EIA inventory data in the post-game. Gold up 3.5%, closing at 2035. Gold had that key breakout and now is only 50 points away from its all-time high. Copper down 2.2%, closing at 3.99. And uranium up 1.5%, closing at 51.10. The U.S. Treasury yield down 26 basis points, closing at 3.31. Yield at a level we have not seen since September. The key news to watch is Friday's jobs numbers. It's interesting that the release of critical news like this is coming on a day when many global markets are closed for the holiday. And early next week, we'll see the release of both the CPI and the PPI inflation numbers. We'll also hear from the Bank of Canada on rates and monetary policy. This week's feature interview guest is commodity expert Adam Rozencwajg. Eric, why did we get Adam back on the show this week?
Well, Patrick, last time we had Adam on MacroVoices, he and I were in very strong agreement about an outlook for the oil market, which proved to be completely, totally wrong. Okay, what happened? Why were we wrong? Did we have the fundamental story wrong, or did we just get the timing wrong? And is the fundamental story still in play? Is it going to happen just later than we expected? Or has the outlook changed completely? I have my own set of views on that, but I wanted to get an update from Adam and just see where he stood. After that, I want to move on and talk about both precious metals and also base metals, because copper is the most important commodity to energy transition. So I want to get Adam's update on those topics as well.
Well, Eric's interview with Adam Rozencwajg is coming up as MacroVoices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Adam Rozencwajg, co-founder of Gehring and Rozencwajg, a commodity research firm and fund manager. Adam, it's great to have you back on the show. I want to start out with, the last time we talked, you and I were in strong agreement about something that, either we were wrong or it hasn't happened yet. And that is that we both thought there would eventually be a very significant increase in energy prices due to lack of supply because of insufficient investment. I still hold that view, although it's on hold until the coming recession plays out. It seems like the expectation that increasing Chinese demand was going to be the catalyst that would really take things forward, was going to change everything. Didn't really happen. Now, as we're speaking, we've just had a surprise OPEC announcement, which has jerked the oil markets considerably higher. But that was a reaction to a surprise move on OPEC. Before that, we were really plumbing lows that you and I didn't expect to see last time we talked. So what happened? Has the outlook changed? Is the hypothesis different now? Or is it just a matter of waiting for things to, for the market to stay irrational for as long as it can before it finally turns in our direction?
Lots of great questions, and thanks so much for having me back. Happy to be here. Really looking forward to our discussion today. So, before we started recording, we confirmed here that we said the last time we spoke was last July, so July of 2022. And as you mentioned, depending on exactly when in the month we spoke, but natural gas prices here in the U.S. were probably around $7, and oil prices were over $100. And here we are, we outlined, like you said, a very bullish view a year ago or just under a year ago. And here we are today. And before the OPEC announcement, oil was down to 70, and gas, which is even more shocking, was all the way down to $2, which is basically approaching the all-time or 20 plus year low, which was reached about $1.91 or so back in the summer of 2020. So like you said, the question is what's happened? And for the most part, in fact, throughout, I would say that everything we talked about last year is still very much true. And when we look back 5-6 years from now, we're going to say, what was this decade about? And it'll have been about the decade of shortages. And the reason for that is because we just have not spent enough money in this sector. It's really as simple as that. If you look at capital spending in the energy business, you're still down 60-70% from where you were in 2014. And you're almost at the all-time low. You're up a little bit off the COVID lows, which is sort of understandable, but you're still 30% below pre-COVID levels on oil and gas spending. And so until you fix that problem, you're really not going to change the bigger theme here. Where we did get things, where we were early, is that we had expected the fourth quarter of last year to be a really tight pinch point in global gas markets and global oil markets. And that didn't come to pass. And there's some really interesting reasons why. The fourth quarter normally is a period of very strong demand for both natural gas and oil. A lot of it has to do with the weather, as things are cold. We use natural gas to generate electricity for air conditioning in the summer, but we use a lot more of it for heating purposes throughout the winter. And so winter is your typically most energy intensive season. And this past winter, we just had incredibly mild weather in both the United States and in Europe. And something else happened from a gas perspective in the US, and that is we lost one of our biggest export terminals, the Freeport LNG natural gas export terminal down in the Gulf Coast. That caught fire back in April of last year. It was 2 BCF a day, and that was offline for, over 200 days. So it's about 400 BCF, billion cubic feet of natural gas demand that we effectively lost last year. And we saw inventories in the US increase by about 400 BCF per day, or 400 BCF rather total relative to averages. So I think that that's entirely explained by the fact that we lost Freeport. And then in Europe, they went from a very, very tight gas market to a very loose gas market because winter just never came. And you and your listeners may have heard articles or listened to podcasts alluding to that. But when you look at the numbers, it's really, really shocking. You're talking about the warmest winter in Europe in 40 years. And thank God that happened. It really got them out from a very, very tough spot with Russian gas volumes curtailed after, first of all, the Russian invasion of the Ukraine and then the Nord Stream pipeline issues and things of that nature. You lost 15 BCF a day of your imports. That's huge. And the only way that they could be bailed out, they being Europe, was by really, really mild weather. And that's what they got. So that explains the gas market. The question, of course, is now when you look forward in the US here, Freeport's back up and running again. So those 2 BCF a day are flowing. That demand is back. And in the rest of the world, the question now turns to, okay, great, we had this warm winter. We can either hope we keep getting record warm winters, or we're going to have to find some way to replace that 15 BCF a day of Russian pipe imports. And if you were to put that all in the LNG market, the liquefied natural gas seaborne market, where you cool gas into tankers and you put it out on the water in vessels, that would be like a 40% increase, 35, I think, percent increase in the global LNG market. So that can't be absorbed. So I think you've now gone from what would have been a bullish macro story, long-term macro story with a very, very near-term acute pinch point being the fourth quarter last year. That's clearly been pushed out, but you haven't changed any of the main big picture macro drivers in the energy market, which still points to very, 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 very tight balances going forward.
And with respect to the oil market, we both thought that the reactivation of Chinese demand when China reopened its economy would be a big catalyst to change everything. It seems like that's mostly played out, and it's not completely back online, but China is making a fair amount of progress. Of course, we've had a completely changed geopolitical tension situation between the United States and China. But in terms of industrial demand, they're coming back. Are we about to see oil prices? Have they bottomed? Is it time to put the longs on oil, or are we not there yet?
Yeah, I think so. What's really been interesting about the oil markets since we last spoke is what's happened in terms of, price. As I said, we were over $100 last time we spoke, and then oil entered into a pretty protracted bear market from 120 in June all the way to a low of 67 just a couple weeks ago. But also what hasn't happened, which is to say, there hasn't really been much of a demand response in terms of demand destruction. We had a little bit of a weak number in the fourth quarter, but really nothing to really justify the price sell-off that we've seen. And instead, I think what most traders are agreeing on is that you actually have just seen a huge amount of liquidation, a huge amount of paper oil being sold on recession fears and on general deleveraging as you've seen liquidity and leverage in the system begin to come out a little bit. So we've heard this time and again. There's a couple interesting points that suggest that. So first of all, the inventory numbers have moved up a little bit, but really not very much at all. They don't really point to any huge slowdown or weakening. And one of the more interesting features of the oil market today, and I don't want to get too in the weeds here, we are long-term investors, so we're not traders, and I'm sure your listeners aren't necessarily physical or paper oil traders either. But one of the interesting measures that you like to look at is what's known as the contango or the backwardation. So that means, are future oil prices higher than the spot market, or are they lower than the spot market? And it stands to reason that if future prices are higher than the spot price, that's bullish. But actually, it's backwards. What happens is, in a tight oil market, the spot physical, so the near term or the prompt end of the curve, gets bid up because people are willing to pay a premium to get their hands on that barrel. A futures contract on a barrel for delivery next year, 2 years from now is all well and good. But when you have a really, really tight market, you're willing to pay a premium to have that oil in your tanks today. And so what your listeners should think about, instead of the far end of the curve being pushed down, what actually ends up happening is the near end of the curve is pulled up. And so in a tight physical market, a typical crude curve is what's known as backwardated. The near-term contracts are more expensive than the long-dated contracts. So that was the case last summer. You had near record backwardation in the oil markets, and then oil prices sold off, nearly 45%. So you would think that that would mean that the balances had loosened, that the market was getting more and more amply supplied. And if that were the case, your backwardation would have gone into a contango. But that hasn't happened at all. The entire curve has moved down. And again, I don't want to get too lost in the weeds here, but I don't recall another major oil sell-off that has not been associated with the market swinging from backwardation into contango. If in fact this market were oversupplied, that's what you should have seen. You haven't. You've just seen people selling oil at any duration all along the curve. And to me, that points to a lot of speculative unwinding.
What will be the catalyst to bring the price around? A lot of us thought it was going to be Chinese demand. Chinese demand has come and gone. That didn't seem to do it. A lot of us have focused, as you've said, on backwardation staying in the market. Okay, we all think that. It hasn't really turned the price around yet. Is there a catalyst coming, or do we need to really wait for the end of the year to see more demand come into the market as we get closer to winter heating season again? And will we be in another situation where it's really dependent on weather?
Oh, look, as far as trying to pick catalysts for big market turns, that's always a very dangerous game to play. But what I can tell you is that as the market gets tighter and tighter and tighter, which it is right now, it becomes much more prone to black swan events. For instance, we just had this big OPEC cut, announced last week, a big surprise. The oil markets were up Monday, April the 3rd, 10%, and oil stocks did very, very well. And I think you could start to see more things like that, whether they're OPEC cuts or whether they're geopolitical disruptions. All I can tell you is the market is awfully tight right now. And when things get tight, weird things begin to happen. But the other thing I would point out, you talked about a few issues there. You said, we were hoping that China would be this big catalyst, and you were hoping that, other elements like that. I wouldn't count out China's reopening just yet. Lee and I just got back from Hong Kong and Singapore. And one of the more interesting observations we had when we were in Hong Kong, we talked to a lot of people, mainland Chinese are all over Hong Kong, as always, but more and more so. And one of the things that was communicated to us, which I thought was kind of interesting, is that they just don't have, particularly on the international air side of things, they just don't have that infrastructure back in place yet. And you might say, well, that's crazy. How could they reopen and have this big, massive reopening without, managing getting the airplanes in and getting the pilots ready and stuff like that? But people don't fully appreciate, you're talking about 90 to 100 days often in order to book out route reservations, in order to get gates at different big airports around the world. So if you wanted to fly from Shanghai to London 3 times daily, you can't just decide to do that on a whim. You need to take some time to get the planes positioned, get the pilots positioned, and then most importantly, get your airport gate reservations in line. And you'll recall that, this whole reopening in China was very, very unexpected. And I think it was unexpected by the party as well, and unexpected by the leadership. It was really the response to huge protests within China. And so I don't think a lot of these things were in place. So now here we are, beginning of April, we're kind of 100 days or so on from those events. And I would suspect that you're going to see a lot of that fireworks, if you will, from the China reopening that you didn't necessarily see straight away begin to work its way through the system. Obviously, industrial production is a whole other animal. And like you said, those numbers are actually looking pretty good. Domestic travel in China is looking really good too. But what you're not seeing is the airline numbers back up to where they should be. And I think that that'll be the next shoe to drop here. So I'm not ready to count out the China reopening story just yet.
Let's move on to a commodity that is performing extremely well, which is gold. We've seen a big rally here on Tuesday afternoon that we're speaking just today. We finally saw a decisive break above the round number resistance that we were experiencing at 2,000. So we're looking at about 2038 on the June contract as we're speaking right now on Tuesday afternoon. It seems to me, it's easy to explain why this market has been so strong with the apparent forced changing of the Fed's hand, or challenging of the Fed's position in this Silicon Valley Bank route. But boy, we're really starting to approach all-time highs again. The last couple times we were there, they proved to be very formidable resistance. What do you think happens next?
Well, I think every major commodity bull market has a huge gold component to it. That was true from 1929 to 1940. And people forget that, that was the first really strong commodity bull market of the 20th century. Not exactly what you would expect, given the fact that world was in global depression at the time and commodities are thought to be so economically sensitive. But, that was the first one that had a huge gold element to it. Gold stocks rallied tenfold over that period. The 1970s as well. And then from 1999 to 2010, gold was all, if you look at kind of, the full cycle, gold tended to be the best performing sector, but it really paid to pick your moments. And so, going all the way back, we were heavily invested in the gold market until about 2020. And then when oil prices went negative and gold was holding in quite well above, 1,600 and eventually making its run up to 2063 for the all-time high in August of 2020, we said, okay, look, this is the time we have to begin to reallocate our investments away from precious metals and towards energy. That was a really good call. Obviously, gold has traded down over the next 2 years, and oil stocks have led the market dramatically. But we've always liked the long-term outlook for gold, and the question has always been the right timing, and I think that timing is getting closer and closer and closer. We started adding to some of our gold positions at the beginning part of last year. I think hopefully your listeners, as they get a taste for some of our analysis, will begin to realize we tend to be early on everything, and that was really no exception. And you had some good tailwinds and some good headwinds. And a lot of those headwinds are now beginning to give way. And so the biggest headwind, of course, was that we were still very much in a rate hike cycle last year. However, the positive signs were, of course, the amount of money that was printed, first after the 08-09 bailout, but then more recently during the CARES Act and during COVID and things of that nature. And the fact that Western liquidation was beginning to slow, which it has continued to slow, and it meant that the sort of marginal buyer was coming back as a more a stickier buyer in the East. And then what happened in the fourth quarter of 2022 really can't be understated or overstated rather, and that's the reemergence of central banks as these huge gold buyers. And, there's a lot of rumor and innuendo as to who was buying. Everyone figured that China was buying and that Russia was buying. I think that those are both true. And I think that going forward, that is just going to be an unbelievable, catalyst to potentially move gold prices much higher. How high could prices go? Well, back in the summer of 1999, 2000, my partner Lee was featured in Forbes magazine, and he said that gold could hit $2,500. Remember, gold was like $275 an ounce back then. And his analysis tried to compare the value of the above ground gold supply with the amount of paper money in circulation. And that's how he got his $2,500. If you do that analysis today, you're in excess of $20,000 an ounce. And so the question is, if we've entered a gold bull market, that's going to be very, very powerful. And I think we probably have. I think the fact that central banks are now this huge buyer, when of course in the late 1990s, they were this unbelievable seller. They were selling all of their gold positions. But I think what you're starting to see now is people begin to move away from the dollar, at least on the margins, as a global reserve currency. Whether that's allowed to go forward, whether it works, is still an open question. But I think you're starting to see central banks around the world begin to diversify their reserves away from the dollar and have at least some gold element to it. And that's going to be potentially a very powerful force here that could take gold much, much, much higher.
Do you have a target for what much, much, much higher means? Is that 2,500? Is that 3,000? Is that 20,000?
Oh, look, I think that if gold reaches, if gold becomes a preferred asset class, like it has several times in the past, gold could well be over $20,000 an ounce. If gold even reverts back to sort of a normal relationship between paper currency or any type of financial asset and gold, you could easily see it over $10,000 an ounce. So we're not gold bugs. I don't think that gold is the answer to every problem all the time, but there are moments when gold valuations get extremely out of whack, and it tends to be a good time to buy. And I think we've seen that in this cycle. I think we saw it probably earlier last year, and now I think we are off to the races. So I think ultimately this is going to get completely out of hand. It's going to overshoot what it ought to be at, and I think it'll probably be somewhere between $10,000 and $15,000 an ounce by the end of this cycle.
And how long does that cycle take to play out? That's $10,000 to $15,000 by what date?
Well, I'm, they say never give a price and a date, but I'll say that this cycle will be over in 2030. And, that's going to be the amount of time that it's going to take to get investors positioned a little differently. You're going to have a move, you'll have a pullback. People will say, oh, I told you we shouldn't have had real assets. But ultimately, we need to recapitalize the extractive industries. We need to get several $1 trillion of unspent capital back into that. And the only way you're going to do that is going to be by an unbelievable speculative bull market that's going to attract generalist capital in. All of that told, I think we probably get to about 2030 before that begins to really hit its last blow off top.
Speaking of extractive industries, let's move on to copper. If we still believe that climate change is a problem and that the world is going to decarbonize by 2050, which is still the stated political agenda, that would require more copper than any copper executive that I've been able to find even knows where to look for. What does this mean for copper prices between now and 2030?
Well, I think that was a nice setup. I think it means they have to go much higher, doesn't it? When you look at copper as opposed to any of the other commodities that we look at, there's a couple different ways of talking about it, a successful investment. Obviously, just straight performance is going to be a key number. The percent that it goes in a total return basis. However, another thing is like the possibilities of outcome, right? Like how many different possibilities could there be? And in the case of energy, we're very, very convinced that traditional energy is going to be with us for a long time. But if we're wrong on that, I could paint a bearish story on energy. With copper, it seems almost impossible to paint a bearish demand story in the copper market because you have China that still, believe it or not, is underinvested in its copper infrastructure. And so we like to look at the total installed copper in an economy relative to its per capita GDP. And when it comes to copper, China is still a little bit underinvested there, and its GDP is going to grow going forward. India, which should have about 100 pounds of copper per person right now, is at like 15 pounds of copper installed per person in their economy. So that in and of itself is going to be a huge tailwind for global copper demand. And then, of course, what you nailed, which is something we've been talking about since 2015, is that any move towards wind, solar, and electric vehicles, you're talking about increasing the copper loadings in those end uses by anywhere between 10 and 20 fold relative to what they're replacing. So if you go from natural gas fired power plant to a offshore wind farm, the amount of copper that's required per megawatt hour goes up 10 to 20 fold. Not to 10 to 20%, 10 to 20 fold. So any way you cut it, it strikes me like copper is going to do quite well. Substitution is fairly limited. And from a supply side, it's really difficult to see where you bring on any new mine supply in the next short term anyway. So, when you're looking at oil, for instance, particularly during the days of shale, you could cycle some of that capacity on fairly quickly. I think it's more challenging to do that now. When it comes to copper, it's going to be 10 years plus before you can bring on a major new copper mine. The clocks would have had to start 10 years ago to see what's going to come on next. So I think that market, almost in any world that you look at, is going to do well. Copper prices, where do you top them out? Well, I guess you have to look at where do you start to squeeze out demand. And again, since there's no ready substitute, the answer is probably could easily be $8-10 a pound. It's $4 a pound right now.
Adam, let's talk about this energy transition and how it's going to play out with respect to affordability of the vehicles and other things that everybody's kind of counting on, because we have so many people that are obsessed with a zero carbon future, just really excited about it. And I think there's an expectation built up. It's kind of like, when you first buy computers, they're expensive, but then the price comes down. Well, when we first got these electric vehicles, these Teslas cost $75,000, $80,000. Most people can't afford them. But surely the price is going to come way down. Well, wait a minute. What we just said about copper, is the price really going to come way down? Is there room for this energy transition to become affordable to the average Joe when you consider the amount of both copper and also rare earth elements that are going to be needed for each unit of electric vehicles in order to accomplish this energy transition? Seems to me like everybody's expecting it to get much cheaper. I think it might be going the other direction.
I think you're exactly right. And I can't tell you how few people we can get to agree with us. So it's nice to hear from someone that does. If you look in the last 10 years, from 2010 to 2020, what was notable about that period of time? Well, the cost of capital effectively went negative. It became, it's $17+ trillion of negative nominal yield. So you had the lowest cost of capital in human history, and the price of basically every source of energy, whether you're talking about gas or coal, nuclear, oil, what have you, fell by about 90%. and somebody's going to come back and say that the price of nuclear didn't fall. No, but the price of uranium. So that's I guess what I'm quoting there. Everything fell between 90 and, I guess in the case of oil, over 100% in terms of energy costs. And very few people as of yet, here we are in 2023, have really talked about that impact. I think a lot of people have talked about the cost of capital. And, if you read Jim Grant and others, they talk about the huge malinvestments that have taken place because money was cheap. And when money's cheap, you don't put it in the right areas. But when energy's cheap, you don't invest it in the right areas either. And people don't fully appreciate that when you talk about wind or solar, the amount of material that goes into generating energy is so much more than when you're talking about oil or natural gas. And, for instance, like a 4 megawatt wind turbine stands, the size of a 30-story building and basically is comprised entirely of steel and the basement's made of cement. Well, if your price of your energy collapses by 90%, it stands to reason that the cost of that steel is going to come down too. Copper in 2011 was $4.50, and by 2017, got down to $2. So I think that's very, very typical. You saw that across a lot of metals and a lot of materials, most of which was the embedded energy cost inside that. Because if you think about it, what's the cost of copper? Well, it's the cost of burning diesel to drive these trucks all around and crushing the ore and refining it and things of that nature. So when we look back on the last decade, I think people have to really take stock of these two massive tailwinds. We had cheap capital and cheap energy. And what did we get? We got a massive investment boom in things that were capital intensive and energy intensive, namely wind and solar and electric vehicles. So you're totally right. Everyone has extrapolated what they call the learning curve. They think that Moore's law is basically taking hold in renewables. But in our models, we actually went back and we tried to attribute how much of the cost reduction of wind or solar or batteries was the result of capital and energy, and then how much was the result of a plug for all other factors. All the other factors has been basically pretty stable. And the main driver, I think 85% of the driver of the reduced costs over the last decade has been cheaper money and cheaper power. So what happens when those start to move higher again? People are tripping over themselves to say how fast the cost of wind, solar, and EVs can fall. Well, what if they rise? And I think that's what you're starting to see now. So, the Constellation project offshore Massachusetts is already forced to renegotiate its power tariffs. You're starting to see Duke, Dominion, and several other major guys write off billions of dollars of their solar fields. And this is all within, 8 months, basically, of capital costs and energy costs rising. So I think, looking back, the huge boom in wind and solar in the past decade will have been more than anything else an artifact of cheap capital and cheap energy. Longer term, if we want to address carbon, we need to go nuclear. And I think hopefully that's beginning to resonate with people more and more.
You just read my mind. My next question was going to be, boy, if you and I are anywhere close to right about energy, this is setting up to force a nuclear renaissance. And I think there's going to be an awakening to nuclear. How do you guys look at it? How do you see it playing out? What's the time frame for nuclear? Do you think it's likely or certain to happen? Do you think it's still a question mark? How do you think about the nuclear future?
Yeah. So what's nice is that if you're a uranium investor and you're long-term, and lots of people say they're long-term and they really aren't, but if you really are long-term and you're willing to take a view of several years, the uranium market's quite tight. We have not invested in a new uranium mine in, 30 years, basically. We have two primary uranium producers, one up in Canada, Cameco, and one in Kazakhstan, Kazatomprom. BHP produces a lot of uranium as a byproduct from its Olympic Dam mine in Australia. That's it. So how bad was the bear market? Well, in 2018, uranium prices got so low that on a cash cost basis, Cameco couldn't produce profitably from its flagship mine. I've never really heard, and they shut it. There wasn't just talk, they shut it to save those pounds for a future date. So how bad were things? I've never heard of a bear market so bad that a duopoly can't manage to make money. And that's how bad things got. Uranium prices fell from $150 a pound down to $18 a pound at the end of 2018. So you actually don't need much of a Western renaissance to have a bullish outlook on uranium. And when we made our investments, we did not make any assumption on a Western nuclear renaissance. We were talking only about the new build programs going on in China right now, where I think they're building like 30 new nukes a year. The Chinese and the Koreans are basically the only people that can bring a nuclear reactor online on time and on budget. So that's kind of the near-term story. The longer-term story is what you're saying, and that's exactly right, that now Europe and the United States are both warming up to the idea of nuclear power again. They're both beginning to have a newfound appreciation, and that could send demand numbers much, much higher. And not only that, but if you're sort of an optimist, that could also lead to a huge period of energy abundance. They used to talk about nuclear power and its potential being so great that you wouldn't even have to meter. It wouldn't make sense. It would be too costly to send somebody out and meter the electricity. It'd kind of be like how we have water today in our residential buildings. Just kind of, here's the water bill, and it's not based on usage. That's what they thought nuclear power could deliver. And if you let it do its thing, it definitely could. So I'm very, very hopeful that there's a newfound appreciation there. This is not, when you're talking about the West, this is not a near-term story. This is going to be 2030 before you have major new reactors coming online in this part of the world. But they should be some of the most exciting fourth generation nuclear reactors that are being designed right now by some very, very smart people with extremely good pedigrees and backing and things like that. And that stands the potential to be incredibly energy efficient, twice as energy efficient as today's nuclear, which in turn is 3 times more efficient than natural gas and coal, and 15 times more efficient than wind and solar. So this could be a huge, huge, huge step forward, generate effectively no waste whatsoever, and be walk away safe and cheap. So this is all kind of on track for the late 2020s, early 2030s, and it has a huge potential. And I should say, there's a lot of people out there that talk about these small modular reactors, and frankly, they don't know what they're talking about. It's a really complicated area. I've found it extremely difficult to find any good, reliable information on any of these new reactors that people are building. So about a year and a half ago, Lee and I decided to go out and just meet all these companies and understand what they're doing, and go to their labs and go to their factory floors and actually see this all for ourselves. And what we came away with was that there's some really interesting stuff happening, some really interesting technologies. Not all of it is. Some of it is, sort of incremental improvements. Some of it is groundbreaking and really, really exciting. So I think you should stay tuned, but it's not going to be a near-term story.
Let's talk about how nuclear can make a comeback in the West, because as you just said, the real problem that we've always had with nuclear has never been nuclear energy itself. The problem is large, bespoke public works projects in the United States and in Europe end up with massive cost overruns, not getting what they're supposed to get done on time, almost ever. And we literally have the cheapest form of electrical energy production, resulting in the most expensive electricity, because the absorption of that massive capital investment to go through all the cost overruns to build a nuclear plant makes that energy so many times more expensive than its actual cost of production. The only way we can ever get out of that is if we can somehow figure out how to create nuclear energy in the United States and other developed countries without screwing it up. And as you say, maybe the South Koreans have a leg up on us, and maybe we should take study of that, but we haven't so far. So is a revolution around small modular reactors going to be the way we solve this problem, that we can't seem to build large nuclear plants without cost overruns? Or are we going to get better at building large nuclear plants?
It's such a paradox, because you're absolutely right. When I look at how much energy is required to generate a unit of energy, for renewables, it's 5 to 1. So you put in 1 unit of energy, you get 5 units out the other side. For oil and gas, it's 30 to 1. So you put in 1 unit of energy, you get 30 out the other side. And if you look at if you translate that back into dollars, that basically tracks, right? Oil and gas ends up being cheaper than fully backed up, unsubsidized wind and solar. But this really strange one, and lots of other technologies slot in the middle. And then the really interesting one is nuclear, which is 1 unit in 100 units out, 100 to 1. It's the best, most efficient source of power we've ever known. and yet it's the most expensive. And it's a bit of a paradox. It's a little bit strange. I think part of the problem is we obviously demand a huge amount of safety from our nuclear facilities. And I think that, on the surface, that makes certainly a lot of sense. If you said to me, do I want the nuclear power plants to be more safe or less safe? I'd say more safe. However, I would point out that, you built a lot of these things back in the 1960s and 1970s, and they've been running operationally without incident, ever since. So we did it plenty safe before. And the idea of nuclear safety is a little bit of a myth because, nuclear power is by far the most safe form of electricity. If you measure it any way you want to do it, people deaths attributable to accidents, per kilowatt, whatever it's going to be. I think you have a couple hundred people die in coal train accidents every year compared to effectively, nobody having died other than in Chernobyl, which was a military installation and not really comparable. So I think that our fascination and fixation on safety, while appropriate, is probably gone a little bit far, and it's resulted in, effectively checking things to the point and then having to replace things over and over and over again. But I'm okay with that. I mean, probably should have that. But we've just lost the skill and the ability to be able to do some of the more complicated installation procedures on these nuclear plants. And in particular, now I'm going to get really, granular here. And I don't want to lose people, but I think it's important when you think about the new small modular reactors. We seem to have lost our ability to do the high specification welding that's necessary in a third generation nuclear reactor. That tends to be where you see every time these cost overruns is because they come in and they inspect the weld joints and they're not to the specifications, and they have to tear them out and start all over again. And that obviously adds huge expense and time to the project. So the question should naturally be, well, do the small modular reactors address those weld joints? And the answer is some do and some don't. The reason that the weld joints are so difficult and so problematic is that the pressures that you're dealing with in a pressurized water reactor for a nuclear power plant is really, really high. So the reactor generates heat at about 500 degrees C, water boils at 100 degrees C. So you need to keep the water that's flowing over the nuclear core under pressure. Otherwise, it's going to boil away and you're going to have a meltdown in your core. And so you do that and you pump very high pressure water at a fast rate to cool the core. Because of that, the pressure is so great that you need to ensure that all your welding is extremely high integrity. Some of the new small modular reactors, particularly the ones that use sodium as a coolant instead of water, have a much higher boiling point and they don't have to have any pressure at all. So if you look at like a TerraPower, for instance, they don't use any high pressure in their systems. It's all kind of atmospheric pressure. And so all of a sudden your weld joints are no longer such an issue. Again, that might be a little bit too much in the weeds, but I do think it's fascinating. Again, it's one of these weird questions where everyone knows that the cost overruns and the time overruns in nuclear is a big problem, but nobody really knows why. Nobody really knows why we're running so far behind schedule and over budget. And when you really dig in, weld joints of all things, something that we should have been really good at by this point. We've been doing them for 200 years, but weld joints tends to be where we really fall down.
Well, Adam, I can't thank you enough for a terrific interview. But before I let you go, I want to talk a little bit about what you do at Gehring and Rozencwajg, particularly what's on the website at gorozen.com. A lot of people think you guys are a research firm because you have such an excellent reputation for commodity research. But there's actually more to the story, isn't there?
Well, yes, there is. And thank you for saying so. We put a lot of time and effort into our research, and the research is at the center of what we do. But we're ultimately, at the end of the day, we're fund managers and have been for, in the case of Lee, 30-something years. I've been doing it for 17. So, we manage natural resource equity portfolios. We do that in a variety of ways. And we use the research that we love to talk about and share with everybody to formulate our investment decisions and ultimately build a portfolio that we think will do well over a long cycle that we see coming. So we put everything that we do on our website. We're very transparent. You started this episode by talking about all the things that we got wrong, and we don't shy away from that either. It's important for our partners and our clients to understand what we get right and what we get wrong. And it's more fun to get things right, but it's important to realize when you get things wrong as well and talk about why that is. So we leave everything up, including our bad calls, our good calls, all of it, and it's all available free of charge for anyone that has interest.
And that's at gorozen.com. Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to get an update from Adam. Now, joining us here in the post-game segment is Nick Galarnik. Now, let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Adam's picture that says, Looking for the Downloads. All right, Eric, let's cover crude oil, starting with that EIA inventory.
EIA reported a drawdown of 3.7 million barrels of crude oil. 970,000 barrels came out of Cushing, Oklahoma, but the big drawdowns were in finished products, with gasoline drawing down 4.1 million barrels and distillates drawing down 3.7 million barrels. U.S. production holding flat at 12.2 million barrels per day. We were previously living under the 100-day moving average, wondering if we'd ever cross above it again. Then suddenly we gapped and so far have stayed above the 100-day moving average, well above it, thanks to OPEC's surprise announcement of a production cut exceeding 1 million barrels per day. Now, a lot of people are celebrating, saying, okay, the bull market is finally on, but I'm expecting this gap to be filled. I think we're going to trade down to $75 before this is over, and maybe it is the beginning of the bull market, but I don't think it's time to rush in and buy up here above $80. I think it makes much more sense to wait and maybe buy the gap fill when it happens.
Yeah, Eric, I put up here on that chart just showing the volume profiling on page 2. What was really interesting about that OPEC news is it gapped through a major high volume price zone, and we're now several trading sessions into holding above there, which is generally very bullish. I think that if any consolidations here in crude oil that stay, maybe we could see a quick dip to 78 or something like that, but generally, so long as dips are being bought, this could have been the trend-changing moment in crude. Obviously, some overhead resistance along the January and February highs right here, but at this point, any one proper break above 82, 83 zone above, we could see $90 crude oil in a span of a month. We'll see how it plays out. Nonetheless, Eric, what's your thinking here on equities?
Well, as I said a few weeks ago, I am still leaning toward a rally up to 4309, which is the 61.8% fib retracement on the whole bear market. I would expect that to be followed by a rollover and then new lows on equities. But I really don't have any strong conviction on what happens next in the short term.
Yeah, Eric, that 4309 level that you're mentioning also corresponds with the August high and is certainly going to be a point where if the market is going to make one more push higher in the post-jobs number, that would be a very reasonable target. Nonetheless, let's talk about the actual levels. Nick, on that S&P 500, what are the levels you're watching from the options perspective?
Spot right now is 40.90 or so as we speak, pre-market on Thursday. Right now, the call wall above is at 41.50, put wall way out of the money at 3,800 or so. The implied move for the April 21st OPEX, again, because we're recording on the expiration date for today on Thursday, is 110 points in either direction. So right now, we have an upper expected move of around 4,200 and a lower expected move of around 3,980. The key support areas right now are 40.50. If you get below that, expect a fast move to 4,000 or so. And if we break 4,000 again, that's where you're probably going to see the VIX take off and you're going to see a sharp move lower, perhaps. I'm inclined to think that we see a slow grind higher into the April OPEX. And then after the April OPEX, perhaps we see volatility pick up. But keep in mind, we have CPI numbers coming up as well, so that could change everything before the April OPEX. I'm slightly bullish for the next couple of weeks, but I'm bearish overall in the midterm.
Yeah, I have to agree with a lot of those things you're saying. Overall, obviously, the jobs numbers that are going to come out here going into the CPI are going to be important. But it's interesting that just around that April OPEX is also going to be where the pig in the python moment is for the earnings season, and we're going to really start to see the reactions as to whether or not corporate earnings are holding up. And so there's a lot of things going into the summer, kind of like that sell in May and go away period, that could be challenging. But on the short term, so long as the market can get through a potentially weaker jobs number, then a retest of 4,200 or 4,300 on the upside are all realistic. What's interesting about that 4,000 level you were talking about, though, Nick, is that that 200-day moving average, which on page 4 I have on there, is just below 4,000. And that has so far held almost the entire 2023 price action beyond a very short blip in March. And I think it will be a real pivot in the bigger picture, that if there was another major sell cycle and spike in volatility, it probably is going to be under that 4,000 level where things will really start to pick up. Nonetheless, let's touch on the Qs. What are you looking at the levels for NASDAQ?
Spot right now on NASDAQ, the Qs is 315 approximately. Right now we have an implied move, again, for the April 21st OPEX of about 11 points in either direction. So upside of 326, downside of 304. Heavy put wall at 270 and a heavy call wall at 350 right now. Key resistance on the upside is 320 and key support right now is 300 on the downside. Again, I'm inclined to think we see some bullish momentum in the short term, and in the midterm, probably a test of the lows perhaps by September, October or so. But interesting to note that certain names are outperforming. Like, for example, right now, Google has released news in the past couple of days that depicts that their new supercomputer is more powerful than NVIDIA's with respect to AI and more energy efficient. So that could be a bullish catalyst in the short term. So what I'm looking at is being long specific names like Google, for example, or Microsoft, and then perhaps looking at being a bit more bearish on the overall broad market, that being the Qs. Nonetheless, I do see us hitting higher highs in the short term, but I do see us also hitting the lows in the next few months as well. So bullish in the short term and bearish in the mid to longer term, I would say.
Yeah, it's interesting when I have that chart here on the NASDAQ on page 6, it's been above its 200-day moving average and the relative strength has 100% been there. What's actually interesting, which I didn't have the chart up, was when you look at the Russell over NASDAQ ratio, and it really just shows how small caps have massively underperformed. Obviously, the Russell 2000 just packed with a bunch of regional banks, which has been a huge drag. But you're absolutely right about the fact that the leadership has been in the FANGs. The financials continue to lag. Even the big money center banks have barely rebounded from the banking crisis. And so I would agree that if the market is going to go a little bit higher, a lot of those tech names are probably the ones that are going to continue to contribute to the indices on the upside, and the laggards are probably going to continue to lag. Nonetheless, what's interesting on page 7 here, Nick, is that volatility, we're right at the bottom of the range again. And, I still view this that we're in a bigger bear market, and this is more or less some degree another bear market rally. And so I find it hard pressed to imagine volatility going back to 2021 lows where we were down at 14 or 15 handles on the VIX. Nonetheless, we're at this key support line, but we could stay down here for a while, right? Like what are the kind of levels you're watching here?
Well, looking at the VIX right now, we're hitting almost year lows right now. And it's interesting to see because last week we had that crazy rally on Friday into close. That was due to gamma positioning in the option markets on SPX primarily. But right now, as I've said in the past, seeing this reversion to 0 DTE options versus 30 DTE average options, the VIX isn't as meaningful as it once was, perhaps. And so with a VIX of around 20 or so, we see, we're expecting about 1.25% broad market moves each day. But we can stay suppressed and see intraday moves that are much larger. Obviously, in the last few days, we've seen very suppressed moves. But last week, we had a rally the last 3 days of the week or so. This week, we've been kind of muted, staying in a very tight range. And with the VIX over here at 1920, it's unlikely we're going to see a huge move in the markets. Again, news could change that, right? If we get some piece of news that comes out of left field, we could see a huge spike in the VIX and a corresponding decline in the broad markets. But for now, again, it seems like it's calm waters before the storm. Now, over on page 8, we have the US dollar index. Eric, what's your thinking here?
Well, it's tempting to say the dollar is trending lower if you look at the chart, but we're still within the consolidation zone. We would need a new daily close below 100 on the Dixie in order to really seal the deal on dollar weakness and show evidence that a new downtrend is really in play.
It's interesting for me, Eric, because as we approach the bottom end of the year range, which is more or less around this 101 level, the dollar weakness is still prevailing. But in my mind, I'm not so convinced that there's another nasty leg lower in the dollar yet. I mean, anything is possible over a long enough time period. But my current speculation is that even if we temporarily break down to 100 on a temporary basis, it would resemble potentially something very similar to what happened in crude oil going down to 65. It rapidly reverses and comes to the top end of the range. My thinking really is that the dollar is far more likely to be range bound in this 100 to 105 range in the coming weeks or month. And the next really big currency move will probably come in the summer going into the third quarter, where we could potentially be seeing a economic recession confirmed, and potentially a dollar could even act like a safe haven in that period. That's going to be really interesting to see.
Now on page 9, we have gold futures, which are now hitting almost all-time highs. What's your thinking here, guys?
Well, there's plenty of progress for gold bugs to celebrate, but the question becomes, okay, now what? We're flirting with channel resistance. The top of the trading channel is at about 2054, 2054. I'm looking at 2038 as I'm recording, so we're just a little distance below that. And just slightly above that, between 2060 and 2080, is the range of very heavy overhead resistance coming from the highs in 2020 and 2022, with, of course, 2020 was the all-time high for gold. So the question becomes, are we going to just punch through it? Seems to me like we're overdue at this point for some kind of a pullback or correction. We've got plenty of room to go to the downside. We could get all the way down to 1900 without invalidating the uptrend that's in play here. And it does not seem sensible to me to expect this rally to continue on its recent rapid upward trajectory. When we're already at the top of the trading channel, it's about the right place for a rollover to happen, and we've got major overhead resistance just above the market. If we could somehow rapidly power through that resistance and get to new all-time highs, that would be incredibly, incredibly bullish. But I think it's much more likely that we will get to new all-time highs, but maybe not till this summer sometime, and maybe there's a fair amount of consolidation ahead of us in order to get through what is a very, very significant resistance level just above this market.
Yeah, Eric, when listening to Adam, the potential of a really big gold move in the remainder of the decade is certainly possible. I'm looking at it far more tactically. Although I feel that this run on gold has been really bullish and really nice, the one thing that I'm really trying to think through is, are we getting a little ahead of this too early? Overall, I think we could have a scenario where when liquidity starts to strain the markets, that gold could still throw back at some point, and that is really in the post period where the Fed is starting to legitimately ease, and there's some liquidity coming back in the market where the really big push in gold can happen in the latter part of the year. So as we approach these all-time highs near 2100, while it's certainly possible that we poke above that overhead resistance, I still think that the really big move in gold is probably going to be later in the year, and that at some point here, gold is likely to pause and backfill. I wouldn't even want to call it a sell-off, but I think that it's going to not be a straight line up from here. So I just wanted to touch on that 10-year Treasury yield on page 10, and simply we had a major support line between the 340 to 350 level, and now we had the yields break now down to new fresh lows for the year, and we haven't seen these kind of levels since September, and it really comes to the back of weaker jobs numbers that are starting to show the economy slowing, which certainly has a disinflationary impulse that has many bond bulls getting excited. It'll be really interesting to see see whether or not we see the 3% level in the coming weeks.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as a link to the chart book we just discussed here in the postgame, and a number of links to articles that we found really interesting. So you'll find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend, that is Eric spelled with a K, and follow Patrick @PatrickSeresna. On behalf of Eric Townsend, Patrick Seresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Seresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.